Investor perspective right now. Kim Inglis, portfolio manager at Raymond James, is joining us. Kim, thank you so much for being with us. If we could start just broadly with the Canadian banks, how are you thinking about them as an investment right now with a whole, wall of issues you can just rattle off, rising interest rates, exposure to housing, some exposed to the U.S. Is this a sector you want to get in front of?
Relative to the U.S. banks, I do still think, despite all the noise that you just discussed with the last guest with TD, I think that Canadian banks are still a good option, especially relative to the U.S. banks. They are still, well capitalized and strong free cash flow and that sort of thing.
And is that based on, you're getting a nice yield as well, about 5%? Are you doing some homework around valuations, or is it a sector that you just kind of own broadly because they provide that kind of consistency in your portfolio?
Right. So, generally speaking, I always try to have very broad diversification in my portfolios, largely from a risk management perspective. So with the Canadian banks, the way that I access them is through an ETF where I get equal weight exposure to the big six banks. So as an example, TD, the weight in that's going to be, 16% or so. Hedges out some of that risk should there be more noise with TD.
And I think that ticker is ZEB. That's the BMO Equal Weight Bank ETF that you gain exposure through that. And I think just that concept of equal weighting them has become even more interesting if you apply that to conversations about the U.S. market. Right now, many people look at the resiliency in the U.S., but if you equal weight their performance, say, in the S&P 500, it's clear that only a certain segment of the market, those large cap tech, have been kind of doing a lot of that work for you. How do you think about, your exposure to areas like in the U.S.?
Yeah, so I really like the U.S., especially, relative to other areas in the world, versus Europe as an example, where, the U.S. is dealing with similar issues that the whole rest of the world is dealing with, but Europe, as an example, is, the proximity with Russia, Ukraine poses some issues. The U.S. in general, I like because it's a well-diversified market. So, as a Canadian investor where you're kind of, pigeonholed a little bit by financials and energy, you can get a lot better diversification in the U.S. But as you mentioned, the U.S. can be a pretty tech-heavy area, about 40% or so of the broad market could be considered tech, which therefore could mean that if you're just strictly investing in the U.S. market and not looking at it, drilling down a little bit further, you can see a lot more swings one way or another. So the way that I'm investing in that is also using another ETF to kind of diversify that exposure through an ETF that gives a bit more defensively positioned basket underlying it.
That's a low volatility U.S. equity ETF?
Mm-hmm.
And is that, when you say defensive, is that utilities, those kind of sectors, or are there stocks that have defensive characteristics because of their balance sheet, et cetera?
Yeah, so with that one, it is focused on low volatility. So, its focus is on having a lower beta. So as a result, tech, as an example, is way down the list in terms of the exposure of that one. In terms of sectors, it's more heavily weighted to two more defensive areas of the market, like consumer staples, utilities, and that sort of thing. So it gives you, it's a good complement if you've got other U.S. growth names to add in something like that to give you better thorough diversification in the U.S.